Good morning. Good morning and welcome. It's not quite as cold as last week, but we have a fireside chat for you nonetheless. I'm Peter Henry, Vice Chairman of the Economic Club of New York and Dean Emeritus and Professor at the NYU Stern School of Business. I'm very pleased to introduce our guest speaker this morning, fellow member and former club board member, Ed Hyman. Ed is Chairman of Evercore ISI, Vice Chairman of Evercore, and heads Evercore ISI's Research Economic Team. For the past 43 years, Ed has been ranked by the Institutional Investor Poll of Investors for Economics, and has been ranked #1 for 38 years. Prior to joining Evercore ISI, Ed was the chairman and founder of ISI Group, LLC, which is the broker-dealer, and ISI Incorporated on the funds management side. As many of you know, ISI Group has employees around the world, with headquarters in New York and offices located in Boston, Fairhope, Houston, London, Los Angeles, St. Louis, San Francisco, Shanghai, and Washington, D.C. ISI's broker-dealer clients are institutional investors in the U.S. and abroad. Before forming both of these companies in 1991, Ed was vice chairman and a member of the board of C.J. Lawrence Incorporated, which he joined in 1972. He was an economic consultant at Data Resources Incorporated from 1969 to 1971, and he has previously served as a board member of the International Tennis Hall of Fame, Capital Trust, Said Holdings Limited, 10 Gracie Square, St. David's School, Collegiate Schools Finance Committee, as well as our own Economic Club of New York. Ed is a board member of the China Institute and is a member of the Advisory Committee for the New York Public Library's Financial Services Leadership Forum. He also serves on the Finance Committee of Bowdoin College. He earned a BS in engineering from the University of Texas in 1967 and received his MBA from MIT in 1969. As I said, our format today is a conversation, and we're delighted to have as our interviewer one of our newest club members, Vonnie Quinn, who is the co-anchor of Bloomberg Markets European Close and the anchor of Bloomberg Markets Americas on Bloomberg Television weekdays from 10 a.m. to 1 p.m. Eastern Time. You've probably seen Vonnie on the air in the past, interviewing U.S. and global central bankers, presidents, prime ministers, and other legislators, CEOs, entrepreneurs, and strategists about macroeconomic themes and controversies, the direction of policy and markets, along with the leading stories of the day. Vonnie joined Bloomberg in 2006 after completing an MA and an MS in journalism from Columbia. As Ed and Vonnie take their seats, and I'd ask them to please come up, I'd like to remind everyone that this conversation is on the record, and we do have media in the back of the room. After Vonnie and Ed's conversation, I'll moderate questions from members and their guests, and as is our practice, we will wrap up sharply by 9 a.m. Please give a big hand to Ed and Vonnie.
Thank you, Peter. Thank you.
Thank you. I'm so excited to be here. I have to say I almost didn't turn up because Ed was so kind to give me $5 trillion just a few minutes ago, but it happened to be Zimbabwean dollars. So Peter said a lot of what there is to say about Ed, but obviously this 38 years as #1 ranked economist with Institutional Investor is just a phenomenal record. And I don't know anyone who's done anything for 38 years, never mind do it well and at the top of their game. So I know you all know his worth and his value, and I hope I can do some justice to your views today.
Bye, thank you.
So let's get going. You're one of the best, if not the best, market and business cycle economists out there. The econometrics model that you learned at MIT and then put into practice at Evercore ISI is just world famous. Let's begin with something very current. You've said yourself that President Trump uses the stock market as a quote-unquote report card. Right. We had the State of the Union last night in which he called the US an economic miracle. Mentioned many statistics. We didn't hear much in the way of new policies, and I'm wondering if you see anything fiscal on the horizon that might keep the so-called Trump trade in place.
Yeah. The only thing that could come up would be the infrastructure, but it's not that likely. So there's not a lot coming up, and that brings up the 2020 election, and the economy is slowing right now, and the only thing that could happen is if it was to slow in 19 and then 20 and start to pick up in the latter part of 20. So it could be good timing, but right now it looks as though it's going to be a slower pace than it has been. That said, The economy has increased about 50% in the past decade, which I don't know if you think that's a lot, but it's notable. And I travel constantly, and every place I go to, you can just see the prosperity, not in rate of change, but just that it's so much better. Like Boston, for example, is really strong, and you can just see it everywhere. I was on the West Coast last week. It's very strong. I got a kick out of the Super Bowl because you got Atlanta, and that beautiful stadium, and Atlanta is just booming. LA is booming, but its real estate is weakened quite a bit. And then Boston, I think the Patriots are from Boston, and
You did.
it's booming too.
You did mention the other day when we were speaking where we are in the business and economic cycle, and you had a good reference to the Super Bowl.
Yeah, so that's what one of the things I'm most interested in right now is this topic. The economy probably grew in the first quarter. If it grew in the second quarter, if the US GDP increased, it will be the longest expansion on record, be 40 quarters. The longest was 39 quarters in the 90s. And that will get tongues wagging. Peter, you interviewed Larry Summers, and when you were discussing with him when the next recession would be, he mentioned Australia. And Australia, as you know, has been at it for 28 years. And you said, no, Larry, this is being recorded. I don't want you to give people the impression you think the next recession is 15 years out. But once you get into the second quarter, and it's the longest ever, you'll be asking the question, what's what? And this is what I think is happening. China, this is the first expansion that China has dominated. China really became China as an economic force in 2007. And so this is the first time they've been really driving global growth, which they have been. Second, these forces are now in place for 2 decades: competition, technology, and globalization. They're driving growth and keeping inflation down. And they're always getting stronger, and that's now a force in the current episode. And so those things are making the cycle longer than it's been in the past. And so we'll have to cope with that. I don't see a recession it'll be a couple of years out, if not longer.
I think you called it the Tom Brady of biological
Right, so I'm into any performer that's old, and so we're chronologically old and biologically young, or let's say, I would say that we're Tom Brady when he's 50.
Wow, okay, excellent. So I'm sure a lot of you know, but one of the things that Evercore ISI does and that you pioneered specifically were these surveys. You put out 400 odd surveys to different industries, effectively surveying business in manufacturing, airlines, banking, retail, you name it, and Evercore ISI and Ed has its finger on the current pulse. You get responses every week. First of all, during the partial shutdown, did those responses keep coming, and what were they telling you?
Well, they definitely. Thank you. So the responses definitely kept coming. So we started these surveys 25 years ago. We asked the same companies, started first with retailers, and we asked the same companies the same question: how's your business compared to what you expected? 50 is as expected. We do an airline survey, and the week of 9/11, they rated business as a 3 on a 0 to 100 scale. There wasn't any business. And that survey has gotten as high as 70. So we do that every week for maybe 25 industries. Thank you. So we started that, and then Jason Trennert took it to a new level. And then Oscar Schlotterbeck is now pushing it ahead. At the moment, the surveys are clearly weakening. Our trucking survey, for example, was 65 6 weeks ago. Now it's 55. So the economy is weakening. I don't think it's going to go into a recession, but it's definitely weakening.
Well, it's fascinating because the last full set of GDP data that we have is for the third quarter of last year. It shows 3.5% growth, definitely slowed in the fourth quarter. What are you looking at now for the first quarter, now that we're starting to get January data? And honestly, a lot of the government data that we're getting now, it's not terribly weak.
It's not terribly weak. The last data we've gotten is we got a survey of bank loan officers. Came out yesterday. It had a significant drop. And then we got the PMI, which had a drop. And I got our trucking survey, which was down 4 points in 4 weeks. So that's I look at the government data and the industry data and our company surveys. And so they're weak. GDP in the first quarter will probably be about 1.5% on a quarter-to-quarter basis. But that will still be 2.5% year on year. So it'll still be, a pretty solid increase, down from maybe 3.5% at the peak last year.
Now, you also survey hedge funds and you have technical analysis as well as fundamental analysis. We'll get to some of that in a little bit because that's the stock market. I'm sure everybody wants to know about that. But let's dig in a little bit more to the economy and the health of the economy. Hourly earnings averaging 3.2% year over year. Kevin Hassett saying that will get to 4%. Do you see that happening? Because that seems to be what's necessary for inflation.
So that's one of the strongest likelihoods is that wages will keep accelerating. We just got this week the Atlanta Fed wage tracker, and it is 3.8. So it's already, close to 4%. And all the wage numbers, like the employment cost index came out last week, it's clearly accelerating. There's little doubt that wages are getting stronger and stronger. And for a business person, whether you run a bank or an auto dealer, whether employment increases or your customer wages increases, you're sort of indifferent. You're just in for an income increase. And so in the employment report that came out on Friday, income was up 5.7. If inflation was, say, 2, that's a 3.7 increase. So income looks it's the real star at the moment. And then the question is, does the star become an enemy if you start to get inflation out of it? And so far, inflation has been restrained by the factors I mentioned: technology, globalization, competition.
Is that what's holding back wage gains? Because by now, with unemployment so low, and not just in the US, but in many of the major advanced economies, and we still took until now to see a certain amount of healthy wage growth. What held that back, Ed?
Well, those things. So competition in so many areas, whether it's airlines or autos or retail, then technology, whether it's Uber or Airbnb, is such a drag, and then globalization. You always can get labor cheaper outside the U.S., and so those things are holding back what would be a stronger, but they're still accelerating, and I assume they'll keep accelerating, and you'll get a business cycle at some point. Inflation will pick up, and the Fed will over-tighten, and that'll be it. But that's not for now, I don't think. What
about the relationship with productivity? Because again, you're at the coalface there. Has that relationship broken down? What's causing productivity to stay so muted?
I think productivity is weak because the economy's been slow. Ken Rogoff had this time is different. After a financial crisis, the economy doesn't snap back. It's slow for a decade. And it was slow. It was 2% growth for a decade. As a result, productivity was slow. And it's still, to me, been disappointing. I thought it was going to be better last year. I thought growth would be maybe 4%, and it was only 3.5 or 3. Now, productivity has picked up. It was just reported this morning, or will be reported at 8:30. It's picked up from maybe 0.5% to 1.5%. But that's still not great, but it's getting better. But at this point, with the economy slowing back down, productivity will, be weaker again. So I'm not particularly betting on anything big there.
Which brings us to the question of monetary policy, and there was obviously a huge brouhaha recently about the change in language and about the balance sheet. First of all, Is the Fed at a point now where we don't know what direction the next interest rate move is?
I think that's the point they would like for us to be, where they say, we're data dependent. Read my lips, we're definitely data dependent. The New York Post had this great headline, Trump feeds the Fed, when they had the dinner with Powell. But the Fed had those two steps where first we were a long ways from normal, and that crushed the market, and then the automatic pilot on the balance sheet just drove them crazy. And usually when you make two mistakes, you're pretty cautious on the next step. And so the Fed, I think, is cautious on what they do next. As a result, the market right now is assuming that even if you get stronger data, the Fed is going to be slow to react to that. And that's why the market is having such a big run here, because they think there's a free pass here for a bit.
So you're quite sanguine about inflation, you're sanguine about the possibility of a next recession anytime soon,
right.
And it seems like you're quite relaxed about the economy.
I am relaxed.
Well, that's good. The yield curve is pretty flat, though, and there are a lot of worries out there that this is signaling something and that the Fed maybe shouldn't stand so pat, given that there is the potential for wages to get to 4%, and that could happen pretty soon. Could there be a jump condition in inflation, therefore making the Fed wrong?
Okay, so so when the Fed said, we're a long ways, we could keep tightening. People said if they tighten another 2 or 3 times, we'll have an inverted yield curve, and if that happens, we could have a recession, and that was the thing back in October that set the market off. That's a little bit off the table. My number one worry is that Europe goes into recession. My second worry is that the yield curve inverts. And it's close enough that, and on that, I worry because the world economy is slowing and inflation is low, and you could get into deflation without a lot of trouble. And if the bond yield were to come down, like some expect it to, you could get an inverted yield curve. And if we got an inverted yield curve, even if it was for unusual reasons, I would still think that you'd probably get a recession out of that. So that's a worry for me.
Why are yields anchored so? Last November, we saw the 10-year at 3.24%. We're right back to the 270 range for the 10-year, and the 2-year is going nowhere either, 238 or so.
Yeah. So my hindsight is usually perfect.
Well, that's why people read your research, Ed.
Are close to it. My foresight, comes and goes, but 20 basis points probably does it. Yeah. The German bond yield is, I don't know what it is.
Yeah, about
22.
17 or something. Yeah.
I mean, it's just so low, and Germany is 0, and it's hard for the U.S. yield to get up very much. Plus, inflation's not that high. So I've looked. The market had that huge drop in the fourth quarter, and I looked to see, trying to prepare, could I avoid it if it happened again? And one of the things that happened was the dollar went up 7% in a short period of time. So I'm watching that really closely. Second, oil went up $30 to $70. So I'm watching that closely. And thirdly, the bond yield went over 3%. So if the bond yield were to go over 3%, which might be a good sign for the economy, but that trifecta could get us back to another correction in the stock market. At the moment, like you point out, yields are still quiet. The oil is up, but not that much, and the dollar's sort of stabilized at the current level.
Speaking of the stock market, you said a few moments ago that you saw your surveys in January slow quite substantially. Right. There was a 10-point drop, I think you said, in some of the industries. Right. Was that due to the partial federal government shutdown? Will that bounce back, or are you seeing something a little broader here?
Yes. So first, the government shutdown, pushed the economy down, and you'll get a bounce back. You probably get half a point down in the first quarter, half a point rebound in the second, roughly speaking. But in the work I do, consumer net worth, which is driven by the stock market and house prices, it was up 10%. Now it's unchanged, roughly speaking. That knocks a point off of real GDP growth in the econometric work I do that I started doing at MIT. Second, spreads, BAA spreads in particular, widened out 100 basis points. And that knocks a point off of GDP growth. So that's how I got from 3.5 down to 2.5 down to 1.5. And so I think the economy is slowing for those fundamental reasons. Now, since then, the stock market has come back some, Trump's report card, and spreads have narrowed some. So it's looking a little bit better, and the economy might pick up some. The other gorilla in the room is China. And I'm out and about all the time, plus I have the advantage of working with our teams. And China has put in a ton of stimulus. Don Strassheim says it's the most stimulus they've ever put in modern history. I'm not sure what other history he's referring to for China. but they put in 51 easing moves. And we think they're going to pick up some in the second half of the year, which if they did, Trump would get a sort of free pass on that. We survey 21 companies that do business in China. And that survey has hooked up a little bit. We survey 28 multinationals that do business in Europe. That survey has dropped 2 points in the past 2 weeks. So one's going straight down. The other looks like it might be bottoming a little bit.
Let's stick on China for a moment before we get to Europe. China is a bugbear, and it's one of your main concerns, and you only have 3. Right. So with trade first, how important is it that we get a trade deal done this month? Because it looks like it's going to be this month or not for a long time.
So, Vonnie, I'm pretty short-term oriented with a long-term view, but I'm trying to, as Powell put it, I'm walking very slowly in a dark room, trying not to fall over. And on China, it really seems to me like it's likely to pick up in the next little bit.
When you say pick up, do you mean China growth?
Yes, China growth.
Why? Why do you think that?
Because they put so much stimulus in the economy.
And you don't see any problems with the shadow banking sector or with...
There are a ton of problems, which is why they put in 51 easing moves.
What about if this trade deal doesn't get done?
I'm sorry, on the trade deal. So I'm out and about. I don't know if this room would agree. I can maybe let you know. I guess I cannot. But roughly 100 people think the odds of a trade deal are 100%.
Do we want a show of hands? Who thinks the odds are above 80%?
No, they have to be just above, they have to be like 55%. Because I survey people all the time. Most people think the odds are now that we'll get a trade deal. Then they put deal in quotes. It's whatever Trump says is a deal. So that's one of the reasons the market is moving is because people now assume that there'll be a trade deal. And for a variety of reasons. Trump is desperate to get a deal. She is probably interested in getting a deal. But that is the prevailing view at the moment. And our team, I think, puts the odds at 90%.
And therefore, there will be good economic relations with China that will be beneficial to both countries?
Yes. But this is also, I don't want to give the impression that people think that this is going to be good forever, that this is just, we'll move the ball to the next place, and then we'll see if we can enforce the intellectual property and have a true improvement in trade.
Would it make a meaningful impact on U.S. GDP?
I don't know. I talked to some people that say that if they start buying U.S. goods in the quantities that they're talking about and increase it 10% a year, it could become very meaningful. But I'm not counting on that. That would be something I'm not even sure I'm hopeful for.
Trump has said that he wants structural changes in order for this to happen. What would China allow?
I don't know. I mean, it's whether intellectual property, open up China to U.S. companies. Those are things that are more problematical. And China, I have many, as I mentioned, Peter, I'm on the board of the China Institute. I have many close friends who are Chinese, and they've sort of soured on China because it's a dark place, and they have like continuing education. So if you're working at a company like Evercore, you have to do continuing education about the communist ideal.
Yes.
And young people in particular are like, no, thank you. And so there's a lot of tension in China right now.
So let's move to Europe. You said you saw a 2-point drop in Europe. Obviously, Italy went into recession at the end of last year. You've the Gilets jaunes in France. And it looks like, other countries could very potentially do that too. You don't seem to be as concerned about Europe impacting things as you do about China, for example, or at least at putting an end to the bull market.
I have nothing to say for China, for Europe. They have no, in the case of the monetary policy, you're making a transition from Draghi. So that's sort of leaves a bit of a moment. And on the political structure, the Eurozone might not work in the long term. And so if there's a problem with Italy being in recession or Brexit has an impact on the Eurozone, there's nothing, I can't point to anything in Europe like you can in China, where they've already started to stimulate aggressively. And so right now it's just sort of weakening, and that gets you to the next point of reflexivity, which is that central banks are now very aggressive. So the Fed, which I take my cue from Krishna Guha, the Fed is now signaling that they have a balance sheet target, Krishna believes, of as much as $3.7 trillion. Before this, maybe a month ago or 2 months ago, it was maybe 1.7 or 2.7. So this is a much bigger number. And at $40 billion a month, they get there by December. And we think that before they get there, they don't want to do 40, 40, 40, 40, 40, 0. They'll start to taper. So the Fed could be moving away or moving to a QT taper in the second quarter. And China is aggressive, and then Japan is still expanding their balance sheet, and Europe has to worry about their economy there. So you have a very stimulative monetary regime at the moment.
So a couple of questions on that. Given that the Fed is now in sort of pause mode, except for the balance sheet, which it's continuing, but which at least the New York Fed Studley says, why is everybody concerned about the balance sheet? This is just a technical, it is not a monetary policy tool right now. Do other central banks have to delay their actions? Will the Bank of Japan, for example, ever get away from zero interest rates?
Probably not. I mean, that's the scary thing. If you sit down in the evening and start reading about the world economy, Japan is a real troubling spot because they've done all this stimulus and they still have basically zero inflation. And then Europe doesn't have much inflation. And so that's where you get to this aggressive policy response that's going on now by the central banks. And what a switch from like September of last year when we were all tightening, and now we're all easing. But that's the way the cycle goes. And right now, people are assuming that we got a trade deal. You got the Fed is friendly, and China's going to pick up. And so the market is on a move up. What
does a balance sheet that size now mean to you? I mean, listening to the Federal Reserve representatives, it's just a larger balance sheet. That's always the way it was going to be after the financial crisis, and it's now at least providing liquidity to the global environment, and that should be a good thing and nothing to worry about.
Yeah. It's funny the way things change. Right now we're going through a moment where we're starting to say, well, budget deficits don't matter. I'm going, wait a minute, Ed, please. But that's the new. And now we're going to the point where we say, well, maybe we don't need to have a $1 billion or a $1 trillion, $2 trillion. Maybe we could have 3.5 or 3.7. And I don't have any particular thought. In the long term, I figure we're in real trouble because of the debt levels, and we don't really have any ability to fight a recession. But in the short term, looks like we're going to be doing what I have covered so far this morning.
Let me stop you there. We don't have any ability to fight another recession. That sounds a little scary.
Well, it is a little scary.
But we do have interest rates that have risen a little bit, so there is still
a little bit of room.
What about companies? Can corporate America save us from the next recession, or what happens there? Are companies done spending?
No, I don't think companies are done spending. So as I mentioned, I think the next recession is years out, and so you have time for people to buy more and more Bloomberg terminals. And time heals a lot of things.
I was asking for a friend, not for me.
And one other thing I'd mention is that at the moment, we don't have a tech bubble like we had in '99. We don't have in '99. We don't have a housing bubble like we had in '05. And we don't have a valuation bubble like we had in 1929. I'm picking carefully my shots there. But so we're not at a risk like that. And the first two I mentioned were recent.
Mm-hmm.
At the moment, there are problems, like corporate debt's a little high, student debt. But I don't see any deep problem at the moment, which is phenomenal, given that we're just entering the longest expansion in history, and we still don't have any, at least for me, any visible thing that could blow up in the next year or two.
So you're not at all concerned about lower quality credits, you're not concerned about the FANG stocks, you're not concerned about any of the little things that have come up?
Not concerned is a little bit. I live in a state of tachycardia. I can only have 1 cup of coffee a day. I'm so concerned about everything. But you have to sort of, balance a Rosetta Stone of, what is. And right now, the dominant things is that the central banks are easing, the Fed is easing, China is likely to turn up, and a trade deal is likely. And so you have to shift with those things, and those things were very different. And then, like I mentioned, on a sort of a short-term basis, I'm watching bond yields, oil prices, and the dollar to tell me if I should get more concerned about the risk in the system.
We're coming fairly towards the end of this earnings season. We've had a really great run,
Right.
it seems. But even yesterday, some of the consumer discretionary stocks did fantastically well, and that was on the outlook for Asia.
Right.
So what about earnings? Do we continue to see decreased expectations? What happens with companies? Do they continue to buy back? Do they continue to raise dividends?
Yeah. So I think that one of the risks out there is a decline in earnings, because growth is slowing pretty sharply, and earnings could decline. We're forecasting earnings go up 5%. And one of my dear friends here today keeps reminding me about buybacks. So there's a tailwind for earnings, but we are forecasting a slowdown from 25 to 5, and that's obviously a slowdown. Now, in the fourth quarter, earnings, like you say, they were good. They were 15% 4 weeks ago, and now they're almost 18%. They're 17.5%. So companies guide down and then beat, guide down and beat. First quarter will be a bit of a test because that'll be the first quarter without the tax cut in there. So they'll probably slow down dramatically. But at the moment, I think earnings are likely to increase some. But that's a risk because the global economy is weakening.
So I want to get your thoughts on active management. This is something slightly different, but I know that you have your finger on that pulse too, and I'm curious as to alpha generation and whether it's still possible, whether it's getting more and more difficult. Obviously it is.
Well, we were doing pretty well until we got to this one.
But does that change again? I mean, if we see the return of volatility, spreads widening and so forth.
I don't know. This is when a dollar goes from active to passive, trading volume goes down 90%. And my business is 100% trading volume. So this is a question that I am very interested in.
You're a little biased.
A little biased. I will tell you that when I ask a group of people like this, do you think active will outperform passive in the next year? Like 70% say yes. It's like hope springs eternal. But I don't have a dog in the fight except my whole life.
Let me ask you a different way.
I don't know if it's going to.
So market concentration then. Are too many investors piled into the same assets, the same risky assets?
I don't know. It's just gotten to be very tough. I think that if interest rates were to get back to a more normal level, that active management would have a much better chance of outperforming. And I thought bond yields would be much higher. If you'd asked me 5 years ago, I thought they'd be much higher. And I've slowly given up. And so with that, you have to work really hard to get active to outperform passive.
Speaking of, the profession and the fact that several years ago you wouldn't have predicted, what's happening now exactly. Things have changed over the last few years. How have your econometric models held up? And not just yours, but just generally the profession's models.
Well, when I first started doing that work in the 70s, the econometric models collapsed. They simply stopped working completely. And I haven't found that in this episode. Like I mentioned, consumer net worth, the spreads, the price of money, the price of oil, those have continued. So the models that I use forecast growth to slow to about 1% in 2016. They forecast growth to pick up to 3.5% in 2018. They forecast growth, you with me, to slow to 1.5% this year. And I decided that it's not happening. It's not slowing to 1.5. So I moved it up to 2. So it's in that sense, it's not working. And I decided that it's not working because of fiscal stimulus, which there's about as much fiscal stimulus this year as last year. But I haven't found, I'm not giving up on the sort of scientific approach to analyzing the economy. I'm not a slave to it, but I find that the relationships still are working to a large extent.
Are there new strands to the profession or new strands of thinking that you have started to incorporate just in the since the financial crisis? The strands that I'm thinking about mostly right now is where are we in the cycle? Because it's so hard to know when you're the longest ever, where are we? And so I'm doing, and that's new work. Like I mentioned, I think we're still biologically okay, but that's one thing. And then I'm also, I mentioned 1929 and 1999 and 2005. The way in which psychology plays a role in shaping the business cycle and investments, I'm very interested in. And I find that at the moment, most people are fairly pessimistic. Whether they're pessimistic in their forecast or not, they're sort of pessimistic in general. Like Davos, I couldn't watch it anymore. There's so much sort of negative feeling coming out, and so I don't think this is. I don't think this is the end of a cycle, because I think people are a little too cautious
for that to be the case.
And then just a broader overview question. We're hurtling towards 2020, it seems.
Yeah.
What if there is a change in economic thinking? And so, all of these new ideas, they're not new, but, things like Medicare for all, things like a wealth tax,
right.
They're gaining traction, and a lot of people are very supportive of those ideas. Can an economy just reverse course like that? What would happen in that situation?
So, Vonnie, you're very perceptive. And I don't, this is like sort of an unspoken question. It comes up, after a couple of glasses of wine or something. But there's a fair chance that we're going to have a complete regime change. We'll have a 70% tax rate. I worked for a long part of my career with a 70% tax rate. 1 for me, 3 for you. And I don't know, I seem to be okay. And then a wealth tax. But I mentioned I was in California, and I always ask people, do you think Trump will be reelected? And in New York, it's about 50-50. In California, it was 20% yes. And so then you just think, well, gosh.
It's a lot for California.
Who's the 80%? Of course, a question like that's unfair. Do you think Trump will be reelected? Because you're not presenting who's going to be running again. So it's really not a fair question. But I lay awake at night thinking about that and what the stock market response would be if that comes up, and I assume it would be pretty bad, or certainly the work up to it would be pretty bad. And then I had the jarring experience. I was in Tokyo the election night when Trump won, and I was giving a speech to 250 people who I meet with once a year at 3 o'clock on Thursday afternoon in Tokyo. And so I was all set. And then Trump won. So I had to I was a panic. But that could happen again. You could look like Trump's going to win, and then suddenly you get whoever. So that's a I won't say it's a risk out there, but it could be a big change out there. Maybe Bloomberg will be the next president.
Well, we'll just finish that anecdote. Tell us what happened.
Well, I had very good coaching, I must say, from my Democratic friends at Evercore, and Ralph Schlosstein in particular, who's a big D Democrat, and I love the guy. He said, Ed, well, I'm disappointed, but they're going to ring-fence America, and it's going to be great for business. That's what I told him, and it worked out fine so far.
I think we're becoming very close to the end of our time, but I do want to thank Ed first before you can get to the questions. Ed Hyman, fantastic conversation and really wonderful to have your insights.
Thank you, Vonnie, so much.
And I believe we're not done yet. You all get a chance to ask some questions,
the
I think.
The floor is open. The questions for Ed. Table 13 in the back.
Hi, this is Dan Robbins. How do you think about automation's effect on jobs, if any, when you look at the long term?
So I'm in the technology is good for us. I've had a long relationship with Andy McAfee at MIT, and not long, but a good relationship with him. And his first book, The Second Machine Age, was quite negative, that robots will replace people. And his second book was much more positive. And you saw that jobs have been created now for 100 months. How many months are we going to create jobs when we keep thinking that robots are going to replace people? So I'm in the camp that there'll be definitely people that make buggy whips are going to be out of luck. They'll have to do something totally different. Maybe they'll never get another job. But I think that creative destruction will rule the day on that. And at this point, going into the longest expansion ever with 100 months of job creation, it seems to me as though the facts are on that side. Not to say there won't be displacements, but I think on balance, it's good and Vonnie should help with productivity.
Well, can I add to that and ask you, we didn't have time for it, but obviously robots and artificial intelligence are one element, but you have this gig economy now where people are working several jobs and they're not registered as unemployed, but they're still finding it so hard to make ends meet. Does the gig economy become sustainable?
I think all this is a revolution that's going on, the gig economy and also people working like in Nashville. You can work anywhere. So I see a lot of people now that are working, in places that are much more economically attractive. My son worked for Epic Games in Raleigh. Why it's in Raleigh, I have no idea. But it's booming, and they also have Red Hat there. So these cities that you thought wouldn't be much of anything are now, doing quite nicely. And it's because people can work anywhere and have the gig economy. But I also find that when I travel around, I get the impression that the bottom of our income strata is picking up. And also, I see Walmart sales are better than they have been. So it's not just, visual inspection. The CBO had a paper out last week that said the bottom 10th of income brackets are improving, which makes sense to me given how long the economy has improved.
Let's take the next question.
You finished your formal comments by talking about the U.S. being ring-fenced. The U.S. has been ring-fenced for a long time. It's actually a fairly closed economy. We're not terribly dependent on trade. But you listed at the top of your worries European recession. Given some of the political issues in Europe and the lack of policy tools, do you think that Europe could drag the U.S. economy into recession?
That's why I have it, yes, that's why I have it as my biggest worry. I don't have any, it's certainly big, and I don't have any way to really track, how bad it could get. You have, Brexit, you have immigration problems there. You have a political structure that's not as cohesive as it is here. So that leaves really ECB. And you have a bit of a change there, plus ECB's already maxed out. So I'm not, it's easier for me personally to be bearish than bullish, which is why I can feel that about Europe. But in general, I think right now, China's going to pick up, and I think the U.S. could pick up a little bit in the second half of the year. And with policy where it is and trade working where it is, I'm more looking up. Could I add one more thing that's not to your question? So the correction last year in 18 was the fourth correction in this expansion. We had one in 2010, 2011, 2016, and so last year to me felt like it was a disaster and out of nowhere. But it's actually something that's happened, 4 times now. And after each of those, the economy, the stock market bounced back about 20% in the next 6 months. In each case, because there was a move by central bankers to turn it up. And so I think that's what's happened. And I'm going to revisit your question in maybe 3 or 4 months.
Another question? Or Vonnie, did you have a follow-up?
I was just going to say it's number 1 in your 3 negative risks. Europe economy weakens significantly.
Right.
Sure.
Dave Dubendorf for Artemis Wealth Advisors. I was wondering if you can sort of quantify your comment on the debt concern in regards to timing of the long term. In other words, at what stage does debt servicing at the state and the federal level crowd out discretionary spending?
You're asking me these questions that I have no answer. But I mentioned I'm intrinsically more able to be, glass half empty. And every quarter when the debt numbers come out, I do a debt to GDP and it just keeps getting worse and worse and worse. My assumption is that I'll face the devil, as the book covered. I'll face the devil when inflation picks up and the yield curve inverts. And that may be my Achilles heel. Maybe something else will happen different this time. But I'm assuming that things will go on, and somewhere down the road, we'll get an inverted yield curve, and then we'll get into a recession. At the moment, I think the popular view is that the next recession will be mild. I think if I was to ask people, that's sort of the inside baseball. And I'm not so sure about that. I think the next recession could be, as bad as the last one. But I'm not going to try and get there until those circumstances that I mentioned unfold. And as I mentioned, Vonnie, I think that this expansion could last, for quite a while longer. And if it does, I'd be premature to get off at the moment.
Next question.
Hi, Charlie Garland with Hamlin Capital Management. The question is, in the next recession, whenever it happens, do you assume more QE? And if you do, will it eventually be problematic for inflation and the dollar?
And I want to stick to my wheelhouse. I mean, you know me pretty well, and I don't know when the debt thing is going to be an issue in Europe, and I certainly don't know what the policy response would be in the next recession. But we're in an economy where we are very reflexive, like the move from October by the Fed to now. We move. And so if we get into a recession, I assume if it's a bad recession, they'll pull out all the stops, they'll have tax cuts and spending increases, and the Fed will be creative and try QE, I assume.
In the back, table 11.
Yeah. Do you see this Fed as following any kind of a familiar pattern? Normally, you think of the Fed as trying to be broadly cyclically anticipatory. Is this a change in how they are responding to data? And how do you see them acting if something unexpected happens? Is there any kind of a risk of a shock as a result of a turn in Fed policy?
Well, it seems we've just gotten the answer to your second question. They react aggressively and quickly when it looks like they've moved off in the wrong direction. And I think the Fed is a very well-intentioned institution, and I've always respected, back to Mariner Eccles or the very beginning, or certainly Stan Fisher. These people are trying to do the right thing, but forecasting is virtually impossible. And so I think the Fed is usually sort of lagging events, not because that's their intention, but just because it's so damn difficult. And also monetary policy takes such a long time to work through the system. So what they're doing now, you don't really see. In the models I use, it's 1 and 2 years what the Fed does and what actually happens. And so I was, right or wrong, I was totally opposed to the Fed tightening this last move. And I remember in 2007, the Fed tightened in the spring, I think. And at that point, house prices had been going down for 2 years. And, the people that were involved with the subprime crisis, they were all over it. And that tightening move in 2007 was really, looked like it was not the best thing. So I think the Fed, by the nature of an institution, they tend to be more of a lagging thing than leading.
Just a quick word on the evolution of transparency. we've had a Fed that's been more transparent, even just in the last month, than probably ever in its history. It used to be that you'd have to parse a statement and wait for the next Fed speech, and now they're just bombarding us. That has a negative connotation. I didn't mean it that way. But is it a good thing?
I don't have a strong view. You know, I grew up first with Paul Volcker, who's a absolute legend, and he liked to keep, as he said, keeps cards close to his vest. And the German central bank liked to actually fake people out. They say, I think we might be easing next month, and then they'll tighten. There was Volcker, and then you got into Greenspan, and now we moved to total transparency. The feeling I get is that we're trying to move away from the Fed predicting what they're going to do next, the dot plots, just to say, look, each meeting we'll take a look at it, and we'll do what we think we should do. But I couldn't tell you today what I think we're going to do in September, and I think they're moving away from that.
Well, no one knows what the Fed's going to do, but Abby, thank you for your hindsight.
Hey, Peter, thank you.
And Vonnie, thank you.
Thanks, Peter.